Hello, we are in week 5, and this video is to recap the primary principles of valuation discussed in week 4. Valuation is the one common thread of the various property interests included in the gross estate for estate taxes. We tax the value of the taxable transfers and allow a deduction for the value of deductible interests. And although for many assets fair market value may be easily and objectively determined, for others fair market value can be very subjective. Further, since it is the value that is being taxed, the art of valuation is very important in this arena, and an understanding of valuation is critical for anyone practicing in this area. Why? Well, if you take too large of a discount on a fractional interest included in a gross estate, the estate tax return could be subject to audit by IRS. On the other hand, being too conservative could warrant a lawsuit from the client for too large of an estate tax paid. So think about it carefully before you start applying discounts. With respect to fractional interest discounts, there are two problems to concern yourselves with. One is, what is real estate really worth? What is that real estate really worth? Which is basically, the real estate is your underlying value, if that property happens to be the property that may involve a fractional interest ownership, I should say. And the other concern is, what is the value of the fractional interest? Fortunately, as accountants, the job of valuation doesn't normally fall on us. Expert appraisers are typically required. The more fungible the asset, the easier it is to value. And there are lots of cases where taxpayers and government are fighting over the value. So understand that valuation is a really big deal. So what is fair market value? Fair market value is the amount that a willing buyer pays a willing seller, neither under a compulsion to buy or sell, and both with relevant knowledge and facts. Or it is the price, basically, that the property commands under an arm's length transaction. The highest and best use of value is typically what is involved with valuing real property. When valuing real property, we need to take into account legal restrictions such as zoning, etc. And so, generally speaking, valuations, with respect to valuations, is going to be the highest and best use versus actual use. Now, Internal Revenue Code Section 2032A is the code section for the actual use election. And there is a formula approach to determine actual use valuation under Section 2032A. Now, for estate tax purposes, we are valuing the property owned at the time of death. For gift tax purposes, we're valuing the property interest received by the donee. So with respect to special valuation rules, Section 2704 is the code section that governs controlled entity valuations. And with respect to estate tax valuations, they include fractional interest properties such as tenants in common relating to real estate ownership. And let's go to an illustration on that, basic illustration. So if you have property that's worth $1 million, and it's, let's say that you have 1/3 of that property that is going to get gifted, say, to your children A, B, and C. If the property is worth $1 million, is someone going to pay you 1/3 of $1 million for that particular property that's owned by 2 other people? Highly improbable, because 1/3 interest is not as marketable as 100% interest. So that's your basic concept there with fractional interest and discounting with respect to fractional interest is if someone gets a piece of, if you have a wonderful piece of artwork, a Picasso, and someone cuts a piece of that artwork off and try to sell that piece of it, it's not going to have the same value as the same whole piece of artwork. So I think you get my point on this. So with respect to that fractional interest, there are two principal fractional interest discounts, and they are minority interest and lack of marketability discounts. The discounts many times can be obtained by a good appraiser or from court cases. So in this illustration, as you can see again, we have 1/3 of the interest that's held by A, 1/3 held by B, and 1/3 held by C. And the total value of this property is $1 million, as mentioned earlier. So obviously, we are not going to want to take the full value of each of these interests and have it included in the estate at that amount, or if it's gifted, we're not going to want that total value to be at exactly 1/3 of $1 million, because we know that we would not be able to get 1/3 of $1 million if we tried to sell that interest separately. So that's where discounts come in. And we would discount the value of that interest so that we are not including that amount in the estate at an amount higher than it's really worth. Now, on testamentary transfers, if, say, person D gives testamentary transfer of a remainder interest, and the value to include of that estate has to be determined, what would be the value of that remainder interest? And so what you would have to do, and there were some examples in the problems, is you have to use tables that are included in the regulations and referred to in the discussion forum problems to complete the remainder interest value. And remember that remainder interest, if you go back to an older illustration, let's say you have a property interest, there's a life interest, and you have a remainder interest. That remainder interest, if you're going to value it, there's tables that must be used. So in valuing that interest, you must take into account the applicable federal rate. In the week 4 problems, I gave you a lot of detail concerning how to get to the right tables. And the best way to get familiar with the tables is to work your way through the problems given in the discussion forum. So if you look at the detailed notes that are included in the problems, you'll see that I explain how to use the tables and how to derive at the correct actuarial values. In general, know the following. Table S is for a life interest. Table B is basically a present value table, basically a term interest. Both tables give you actuarial factors of a remainder interest. The income factor and remainder factor should add up to 1, which is the value of the property as a whole. The table amounts are basically a percentage to be applied to the underlying value. So finally, when do we value the property? Property is to be valued on the date of death or on the valuation election date. The election can be made if the effect is to increase the value of the estate and an actual tax liability. Both must occur to make the election, not one or the other. It has to be made if the effect is to decrease the value of the estate and there is an actual tax liability. So keep in mind that Section 2032 was enacted to value the property at a later time so that the beneficiaries of the estate are not hurt from the property that loses its value significantly shortly after the date of the death. So generally, the valuation date is the date of death, and if a Section 2032 election is made, an alternate valuation date of 6 months after the date of death can be elected, or an intervening disposition of property date. So that's it for this summary.